we move on then to one of the topics here, then the very good food company, which I call Very My Berry, and the very good butchers, right? So what do you feel about that company? Yeah, we talked a little about it before, right, in the former part. But so you mentioned you had actually been to to their to their restaurant, right? And you had their burger, the butcher shop.
Yeah, so I went to the butcher shop in Victoria on Vancouver Island last summer. So this was about a month, maybe 2 months after they IPO'd or went public. They had just gone public. I think the price of the shares was like $1, somewhere around there. And I went to the butcher shop. I met the guy behind the counter. I asked him, "How's it going? What's it like working here? How are things going?" And I ordered a burger. I got to eat the burger, try the product, and the burger was good. I'm a big meat guy. I don't eat a whole lot of veggie patties or anything, but I liked it. I thought it was good, and
Yeah.
the people I was with, they liked it as well. So the product, and I only tried it once. I tried the burger, but it was really good,
Mm.
and I think that what they're doing is really remarkable. So long term, I am very bullish on the company.
Yeah.
I am trading in and out of it right now because of the volatility and the movement on the company going from $1 to $9 back down to three.
Yeah.
There's a lot of opportunity in there, and so I am kind of buying in and out of it. But
Mm.
long term, I am a huge fan of the company. I like what they're doing. They're growing exponentially fast. Their top line revenue numbers are extremely, extremely impressive, and I think there is a huge opportunity in the market for their products. I also just went to a little Italian restaurant store, an Italian like grocery store here in Calgary,
Yeah.
and they had very good butcher products there, and they were all
Oh,
sold out except for one product. So I was super happy to see that.
cool.
I think
That's
the
a good
company's
sign.
doing well. Yeah,
Yeah.
I think the expansion's going well. I like
Mm.
the management team. They seem like they got a good head on their shoulders. The company is well funded now,
Yeah.
and for the next year, it feels like it just literally comes down to execution and ability to sell the product and scale up those production facilities that they have. So I'm very big fan of the company. I'd like to see a little bit of positive movement on the stock price, and
Yeah.
I plan to buy back into it. But yeah, I'm very long term bullish on the company.
A lot of people, because it's probably the stock that I've spoken most about on the channel. And a lot of people keep asking me, "Oh, they're doing all the right moves. They're doing everything correctly. How could it keep moving down? Why aren't we see it at $9 again?" And I always have to try to explain to them that it got really hyped in October. And I mean, I don't think it's anything wrong because it does have a lot of potential. But obviously, moving up, like I don't know what that would be, like 300-400%, if not even more. I'm talking, of course, from $2, but like you talked about before, it was at under $1, right? So moving up that quickly obviously is going to have consequences. And especially what I think people now, most people, when they look at it, they look at the maybe PAs. This is a growth company, a disruptive growth company. Just looking at PE valuation, value metrics, it's not going to help a lot. You're not going to understand the company from those kind of views. But looking at maybe PS ratio, price to sales, it also looks incredibly overvalued. I mean, I think if you look at it now, everything's jumping between 50, 60 to 100. And that's incredibly high, right? Whilst there are others like Tattoo Chef is usually around 10, Beyond Meat between 16 to 20. And then you have other growth companies like Tesla trading at 20 also often. But this is like way higher than that. But I think people don't understand, like you talked about the facilities, that what kind of production capacity they're going to have now, like moving on from a half a year ago, about 1 million to 1.3 million pounds per year, to now the Vancouver facility, Rupert facility, being a 37x, right? Basically 37 million pounds. And then later we have that Patterson facility in California with almost 100 million pounds per year. And they've stated actually several times now that when it comes to the Rupert facility, like 37 million pounds, I thought for sure that's going to take several years. But they stated that basically they can see themselves, I think, within a year or half a year to a year, actually, depending, of course, on the demand, but actually maxing out that. So that would mean, I mean, such a huge difference in sales, right? From having 4.6 now in the end of the year for 4.6 Canadian dollars, $1 million, to, I mean, at the very least, I could see them doing everything between 15 to 20 million now in the end of the year. So, how are you looking at that when it comes to those things?
Yeah, so those one, like you nailed it on the head, is
Mm.
valuation on a company like this
It's,
is so challenging because there's no earnings right now. There's
mm,
probably not going to be earnings for a year or two,
yeah,
best case scenario.
yeah,
And so how do you value a company that doesn't make money right now but is growing quickly? And like you said, price to sales is probably one of the largest factors in there. And yeah, if even now at a price of $2 or $3, $3.34 the price to sales metrics on this are still absolutely ridiculous. It's
mm,
50 times price to sales right now. And so if I had told you about that about most other companies, you would say, Zach, that's crazy. Like that's an exceedingly expensive company.
yeah,
So you have to look at the growth rate on here. And I believe last year's growth rate, I want to say it was a couple hundred X, which is really nice to see.
yep,
So they're definitely growing extremely fast. And that's where it comes down to, okay, what kind of growth rate do you put on the company over the next 1 to 2 years? What do their margins look like? And can you forecast any type of at least EBITDA and then hopefully some net income?
yeah,
And when it comes to very good food company or very good butchers, it's tricky to do right now because this market is changing so dramatically fast and
yeah.
because the company's growing so quickly and a new facility here, a new facility there, it really changes the financials. So forecasting is also difficult.
But the
So when you
demand,
look,
I mean, the scary thing is, of course, you can have as much facilities as you want, but you have to have a product that's wanted, right? People have to know about you. But I do like that they feel very confident. I mean, I think in the beginning of the year, they had their products at 300 stores, but they are predicting to be at 3,000 stores by the end of the year because they seem to be making a lot of deals now, especially now moving into the US as well. I think they're up to like 600 or 700 places at the moment, so it's gone quite quickly anyhow. And but the interesting part of it is that they seem extremely well known on in in social media. I mean, if you compare it to other companies, they have about, let's just take a look here. If we go into their Instagram page, think about 72,000. Let's see, the very good butchers. Oh, even 75,000. It's actually just growing like crazy all the time here. And that's huge because there are other companies, plant-based companies like that I also talk a lot about in this company, in this channel, and I'm very bullish about them too. Is Tattoo Chef, which is worth 1.6 billion dollars right now. So they're very much bigger, but yet they have less than half when it comes to. They have about 32,000. For me, that tells us something, right? How popular this product is, and it's the same on Facebook. They have about, I think, 70,000, which says a lot. And for such a small company too, that probably is still very unknown among a lot of parts in the U.S. But I think that's going to change rapidly.
oh, I agree. And it's really interesting. I just pulled up Tattooed Chef price to sales numbers right now and it's
Yeah,
9.3.
yeah,
Right. So like when you look at very good butchers and you compare it to their competitors here,
mm,
they're 5 times more expensive for the amount of sales that they bring in. I think they
mm,
probably have slightly better margins than Tattooed Chef,
mm,
but still, it's a tough thing to compare. But you're right; they're doing an amazingly good job in both the e-commerce side as well as social media. I was going
mm,
through their press release, and it sounded like their e-commerce business was up over 1,000%. So
mm,
I think the company is knocking it out of the park with
mm.
regards to e-commerce sales and what they're doing online. I think that's phenomenal. And if they can continue to get into stores, I think that's going to be the key to success here for them because I think 2 to 3 years from now, we're going to see a dramatically larger increase in competition in this space. Because I don't think I don't think there's enough of a moat in the industry to keep out major players and
Mm.
large corporations from developing and adding to their product line.
Right.
If you look at Beyond Meat, or you look at Lighthouse, or you look at any of the other companies in the space,
Mm.
um, there's starting to become options for each of the different products that these companies are making.
Yeah.
And I think that's going to grow over time. So I think the quicker that very good butchers or very good food can expand
Yeah.
early on, I have no problem with them losing money, as much money as they want right now, as long as it's going into picking up new customers that are going to be profitable in the long run.
Yeah.
Because I think it's going to be an absolute race to the store shelves over the next 2 to 3 years. But I also like that they're doing very good job with e-commerce and online sales.
Yeah.
So I think 10 to 15 years from now, that's
Yeah.
going
That's
to
the
be the
future.
primary driver of how people get food. So
Definitely. Definitely.
short term, yeah. So short term, I think it's a race to store shelves,
Mm.
and long term, I think it's building out the online business. That's how I would look at it, and that's what
Yeah.
I would like to see from very good butchers.
Yeah, because if we talk a little bear case here, then when it comes to the company, like you said, I mean they have taken out quite a lot of money now. About 70 million they took out in basically loans, and which one of the reasons were because they didn't want to dilute the stocks too much, and then I think just a few weeks after or a month after they diluted the shares with another 20 million then, so basically 90 million. And normally, I would say I don't mind it because it's a growth company and it's disruptive. They need to move fast, right? You don't want to sit in a situation where when you're expanding, you have facilities, you have demand, everyone is waiting, and you can't back it up with money, right? You don't want to be in that situation. That would be terrible. So this is to some extent a good problem to have, but but it was a little surprising to me that they diluted the shares that quickly after taking a $70 million loan, considering that they're still such a small company. So, well, what do you feel about that? What do you think about that? If you have an opinion,
Was that a loan or a line of credit? I don't know if it was a loan. Was it a
uh,
loan?
what's the 20? Let's see. Where do we have?
$70 million credit facility.
Yeah,
20 million it was 20 million revolving line of credit and 50 million term loan. So you're right, it was 50 million term loan.
mm,
Um yeah, not it's definitely not great. Like anytime a company has to dilute the shares, especially right after they go out and raise debt, is not a good sign. So it really comes down to like what are they going to use the funds for over the
mm,
next kind of 3 to 6 months, and are they going to get a return on that investment and a good return on that dilution?
mm,
Personally, kind of like I said, I think it's a race right now to get on store shelves and expand as quickly as possible right now, because I
yeah,
think the market has finally opened up to the idea that these products are probably going to grow over time, and this is here to stay. Um, so it's a tricky thing.
yeah.
I haven't been holding over the last little while. I've been
Mm.
kind of in and out. I got out at that $8 or $9 mark, and I'm looking to buy
Smart.
back in right now. So
Yeah.
it's good for me because it lowers the price, but it's really really tricky thing, because when you're running a business, the last thing you want is to run out of money, and
Yeah.
the second last thing you want is to have to raise money when you're low on money, because then you're desperate. And
Yeah.
so as the CEO or as the business owner and the guys making the decisions there, I understand it, because as these facilities open up, they need new equipment, they need the sales guys, and they're going to need this money. And right now, I think people were willing to give them that money.
Yeah.
However, 3 6 months from now, especially if we see any type of turbulence in the market,
Yeah.
it could be much more difficult to raise that money. And the last thing they want is to be desperate to raise money. So it's a tricky thing, and it's definitely a trade-off. It's not great for shareholders, but it probably helps the business in the long run if they can secure capital right now
Right.
at the current levels. It's probably a good opportunity. If they could have secured capital at $9 per share, it probably would have been best case scenario.
Yeah.
Um, but it's part of the game, and unfortunately, when you hold stock in a growth company like this, a young company,
Yeah.
it's definitely one of the risks that you take.
Yeah. Definitely. No, but I agree with you, and I think the positive outweighs the negatives here. I definitely believe that. I think they are making the right moves here, but we talked a little about overall in the industry about moats and trying to talk about this company's moat. Do they have a moat? Because it was one of a subscribers' question too. That do you see them having a unique product? Do they have a moat? What would your, because I've started to think about that actually more, and I talked to a subscriber about that a couple of months ago, and so I actually don't see them having right now a specific moat. I don't really see them having a defense, because if we compare it to Beyond Meat, they put enormous research comparatively, and they're a lot much larger company, of course, into making their burgers and their meat alternatives tasting as much as meat as possible, because they're not targeting the vegans, they're targeting the $1.4 trillion meat industry, right? So they want it to be as texture wise and flavor wise as authentic to the real thing as possible. They put about between 10% to sometimes 15% of their overall revenue on research and development, which is, I think, amazing, of course. But so when it comes to other companies having a chance towards being mimicking, I don't think at the moment VRYYF is there, and this might not be their agenda either, right? They want to have a product that tastes well in itself. I unfortunately haven't been able to order it here from Sweden yet, but you've tried the product, and you said you love meat normally. I'm guessing you don't. It was a good product in itself, but it didn't taste like meat, I imagine, right?
I would it didn't taste like a regular burger. It was closer to more of like a chorizo type meat because
Mm-hmm.
of the seasoning and the texture to it.
Okay.
Um, so here's what goes through my mind when I think of. So we're in the food product, and we're talking about a food product that usually sits on a shelf or in a freezer. And unfortunately, in this industry, it is very, very difficult to create a strategic advantage and create a moat around your product. For instance, you could be Oreo, but now there's 6 different types of rip-off Oreos. You could do orange juice, you could do chips. There are very, very few products in the grocery store, in the entire grocery store, that have a strategic advantage where somebody else can't copy them, where
Right.
somebody else can't just put 2 wafers and a white cream in between and call it a something that sounds like an Oreo, right? So
Right.
when it comes to these type of products, it is very, very difficult to create a strategic advantage. There's almost nobody that can do it,
No.
and it's super difficult. But where these companies do create the advantage and where they do create a strategic differentiator is in the brand behind it.
Yeah.
People buy Oreos because it's the Oreo brand. People
Yeah.
buy Coca-Cola because it's got the Coca-Cola label on it. People buy Tropicana orange juice because they like Tropicana better than Ocean Spray or whatever the other brand is. And so in this specific industry and in this niche of where these guys are trying to sell in a grocery store, eventually somebody is going to come out with a bean sausage and a bean based burger, and they're going to just completely copy
Mm.
everything that Very Good Butchers does. Like,
Yeah.
over the next 2 years, somebody's going to do it. It's going to happen without a doubt. There's nothing that prevents
Now, because
anybody
their
else from doing
ingredient list isn't that difficult. I mean, if you compare it to something like Beyond Meat, which is so much science about behind it, the chemicals, the structure, the way to go
it.
into the creating the perfect protein, basically. They don't have anything like that, like you're stating. But again, like you also stated, it's all about the branding in this business. If you're a well-known brand, you're gonna win out in the long term.
Yeah, they need to be the Oreo of the plant-based meat section. They
And you
need to be the
probably don't know
Coca-Cola.
you probably don't know what a perfect example that is, because being vegan myself, we all know that Oreos are vegan and always have been. So that is a perfect example.
I had no yeah, I didn't know that. But yeah, right? Like, when you look at a shelf of crackers, they're all the exact same cracker. They might even be made in the same facility, but you buy the Oreo ones because you like that brand the best.
Right.
When it comes down to plant-based food, the ingredients matter a little bit. The health things matter a little bit. But if somebody's going to buy a plant-based burger, they're probably going to buy the brand that they like the best. The
Right.
same reason that they buy the Oreos that they like the best, or the Coca-Cola, or whatever the favorite brand is. Because in this industry of products on a shelf, it's very difficult to create a strategic differentiator, because if you have a unique granola bar, I can just make a similar granola bar. I can
Yeah.
make a similar burger. I can make a similar cracker, whatever it is, right?
Yeah.
So the branding is going to be the most important thing. And like you said, their ability to do it on social media and e-commerce
Yeah.
is a very, very strong sign. It is a very, very good strength. And I think long term, I would really like to see that as one of the main drivers for this company,
Yeah.
because I think it's only a matter of time before we see another bean based company with directly competing products.
And to be honest, I've heard some customers saying that there are already products out there that taste similar. Yet I don't know, some like roast field or yeah, company that is quite similar when it comes to products and what they and are quite. I mean, the good thing about one of their advantages is that it's quite a healthy product. Comparatively to Beyond Meat, definitely, and a lot of other plant-based meats out there, because most are heavily processed. Don't get me wrong, this is also a processed product, but I would say minor comparatively. And I think people are going to care more and more about the health perspective when we're moving on to the next decade. But with that said, still, like we talked about, it's not that difficult to copy. And having a brand that is that strong actually gives you a chance to have a higher premium, right? Which means you get better margins in the end, which will be overall a winner for not only the company but the stockholders as well.
For sure. And I think that that's the real opportunity there, is that if they can establish themselves as hopefully the premium product in their market of meat alternatives,
Mm,
that would be the best case scenario. If they can be the number one brand and the premium product, like that is that's what Oreo is. Coca-Cola is usually the more expensive soft drink. Like that's where you want to be. That's the golden zone for any of these CPG products, and that's what, as an investor, I am watching for. Is when I go to a store, I want to see the very good products at eye level. I don't want to see them on the bottom shelf or the top shelf,
exactly.
because that means that this is the priority for the retailer. So that's what I'm watching for. That's what I'm looking for as an investor. And because as of right now, the revenue for this company has not been an issue. They've done extremely well. It looks like they're going to do extremely well,
Mm,
and it sounds like production is scaling up at the same pace. So now it comes down to, can they execute? Can they get into enough stores? Can they properly distribute the product? And can they avoid any product issues or recalls or sicknesses, anything like that? If they can
yeah.
execute and properly manage this growth over the next 1 to 2 years, I
Yeah.
think there's an excellent opportunity for them to become that kind of premium product and premium brand in the
And
category.
I
But
think the
it,
name in itself, Very Good Butcher, is actually a smart name, because it's something that it's going to remind you of something. And I like the whole thing. We butcher beans. We choose to do that instead. So I appreciate that, not only because I'm a vegan, of course, but I like the whole concept, the thought behind that. So I think that's something that when the customer goes and buys that product, they're not going to, next time they want to buy it again, they're not going to be like, oh, was it maple leaf, or was it Gardein? I think they're going to remember the name for sure.
Yeah, and I think the branding and the marketing so far has been extremely good. I also liked the pivot to the very good food company,
Mm,
rather than sticking with butchers. I thought that was great, and they're now entering the cheese or the cheese alternative business.
yeah.
And I think that's a great play as well. I think that's absolutely phenomenal. I don't know what the numbers are, but it was like 60% of the globe is lactose intolerant and
Yeah.
has issues with it. So
Yeah.
if they can really create a product that knocks it out of the park, and it sounds like they have it, I think there's a great opportunity in the dairy industry for this as well. And I
Plant-based dairy
think,
is much bigger opportunity for sure.
yeah, and
Mm,
I think so far that market hasn't been tapped into nearly as much as the meat industry,
mm,
but I think we're definitely on our way there. And I think the trend around the world is transitioning more and more heavily to plant-based food and consumption.
mm.
And so I think the wind is at the back for this industry. I think the company's doing extremely well, and I'm watching the distribution and how these guys can execute. So
Yeah.
I'm very optimistic about it.
Yeah, and I think you also talked about the one of the not a moat either, but today, except the branding, is the execution and how fast you can actually expand. Because the faster you do, that has to do with branding too. People will be more aware of you if you've been out there longer. So, and I still, even though there are plenty of plant-based companies out there today, but it doesn't mean that they have that kind of backing, because being a stock company still, I think there's a difference, right? Because you kind of you get an edge towards the other companies because you can more easily raise money. I mean, if you look at the old financials of the Very Good Food Company, like 1.5 years ago, they had like bank loans that was like 50% interest or something like that. It's insane because there was such a unknown small company. And even now, they got a lot of critique that the loans they got now were around 9.9%. And they stated like, oh, it's under 2 digits. Yeah, I mean, it's playing on the 9.9%. But I think it's still pretty good. I mean, 9.9%, because it is still a small company, but it actually, I mean, going from 50% to around 10% is a huge difference. So I'm imagining that in the future, when they get more and more well known, banks will give out even better loans for sure.
Yeah, it's the financing game is really interesting because the 50% loan is a total loan shark, and that's just gouging them. So that's terrible. So excellent that they got out of that. 9% still, like, if you compared it to other companies, it is not very good. It's absolutely terrible. But because they're such a young company and because there's some risk behind this company, banks probably wouldn't give these guys loans without a personal guarantee, and they definitely wouldn't give them loans for this amount of money. So realistically, like traditional bank loans would kind of be out of the question for a company like this. And so going to the markets like this and raising it in the way that they did is probably their only option. And if 9% was the best option that they had, unfortunately, as an investor, like, we can't complain about that. We can't do anything. We know that the management team went out and got the best interest rate that they could.
Yeah.
But I mean, we can go out and buy a mortgage at 2% right now. So it's tough to compare these kind of things, especially as a retail investor. So the company has to do whatever they can to get that money and bring that money in.
Yeah.
And at 9%, it's not crazy. It's not great by any means, but it's not terrible, especially compared to where they were.
Yeah.
I think the more important thing though is realistically, if the company can execute and properly execute and bring in new stores and then consistently get reorders from those stores, 9% in interest is not going to be much of a concern, because the payoff on what they generate from using that money should be dramatically higher based on their profit margins, as long as they're bringing in store reorders. That's one metric and one factor that I haven't been able to get a lot of information on is, of the, let's call it 3,000 stores by the end of this year, how many of those stores place another order within 2 months? Like, those are the metrics that I'd really like to know about
So what
and
kind of
find out.
sell-through
I
they
don't
have?
think. Yeah, what is the sell-through in these stores? Because so far I've gone to 2 or 3 grocery stores and it looks like they're selling off the shelf, but I also don't know. Maybe they're not getting shipments in. Maybe they can't supply it. I don't know what the story is, but I'd love to know more about the sell-through rate on the products, because that's the only kind of like missing factor in my head. That if we saw that, it would give me a whole lot more confirmation as well.
I've looked at when I've made a video analyzing if people love their products, if it's a popular product, and looking through different revenues from TripAdvisor, from what do you call them in the States? I looked at like 4 or 5 different places for reviews. And obviously reviews is like a minute perspective of the whole thing, right? But it gives you an indication. And they do seem to have really good revenues from hundreds and hundreds of different people, what I've seen so far, and some videos out there too. Again, that's still a small percentage of everything, right? But an indication that it looks like people really love their products. And but we will have to wait and see, right, when they actually when we get those kind of sell through, because when it came to the Q1 earnings call, I think that was the first. It was the first earnings call, I think, or the annuals. He didn't talk that much about that. it was quite short if you compare it to Beyond Meat. Beyond Meat's like 1.5 hours. This was like 20 minutes, but it's maybe not so strange. It was the first ones, and not that big company yet. But I would want to have heard those kind of numbers and those kind of discussions for sure. So
Yeah, definitely something that I'm watching for and that I'm looking out for. But overall, I mean, the industry in general is growing, so it's definitely like that. That's the first check is the industry is growing. Number two is the company and the financials and the sales numbers and how they're doing.
yeah,
And Very Good Butchers definitely checks that box for me. And so now it just comes down to what is the valuation? How do these guys compare to their numbers? How do these guys compare to the rest of the industry?
yeah.
And what does the future prospects look like? And so I'm watching the chart pretty closely now because it it's a really interesting. I mean that pump that we saw to $9, it's been consistently trading downwards now. And so what I'm looking for is I really want it to level out and then start to correct, and that's where I plan to buy back in.
But again, yeah, you have to understand what I've said several times on the channel. You have to understand that average retail investor are not going to deep dive the way we do into this company and follow their growth story as much as we do. And because for me, they have an obvious growth story, and as we know today, when it comes to great companies, it's a lot about the story, right? And obviously, when you take a look at the numbers, you're going to panic. You're going to like, who would put money into this? I mean, you must be crazy if you did that. But that's why you have to see the potential. You basically have to count in the future price to sales possibilities there. So because, like I said, when it was about PS ratio of 100, and I said, well, I mean, the way I counted, I could see within 1 to 2 years having if it is, as they talked about, the production capacity, the way they're going to sell, they could probably have within 1 to 2 years 100 million in revenue. And that would be directly then a price to sales of 4 if the stock price would stand still, which it probably won't. But and that's how I feel you need to think about this, the potential there. So yeah. So the
No, I think you're right. If you're looking at it on a 2 to 3 year time horizon, I think there is nothing holding this company back from dramatically increasing these revenue numbers. And if you're buying it now and saying in 2 to 3 years, this is where I think the revenue is going to be at, and your price to sales number is under like 3 to 5, then oh man, that's a buy all day long.
yeah,
That's an
definitely.
opportunity, and that's something that you should be building into for sure.
Definitely.